Welcome back, my awesome people. In today's episode, I will be highlighting the recent phenomenon of companies focusing on their ESG scores. For many of you, this is a brand new term or concept, and for some of you, you may have heard it talked about by financial analysts. So let's get to the fundamental of what an ESG score is. So what is an ESG score? Well, an ESG score is a way to assign a quantitative metric, such as a numerical metric or a letter rating, to the environmental, social, and governance efforts undertaken by an organization and company. So simply put, an ESG score measures how well a business is doing when it comes to their commitment to the environment, such as climate issues, their commitment to social issues, such as LGBTQ, and their commitment to governance, which can include the company's diverse executive team, leadership direction, and shareholder rights. ESG investors seek to ensure the companies they fund are responsible stewards of the environment, good corporate citizens, and are led by accountable managers. So in other words, ESG scores are shit. They have absolutely nothing to do with the company's fundamental business, and more so the company's ability to show potential investors that they are a conscious and woke company, which unfortunately attracts a small group of investors, because serious investors know that money and emotions don't mix. So whether you are conscious or not of the global issues going on, money is money. In recent years, investors have shown interest in putting their money where their values are. As a result, brokerage firms have started offering ETFs and other financial products that follow ESG investing strategies. Adopting ESG principles means that corporate strategy focuses on the three pillars: environment, social, and governance. This means taking measures to lower pollution, carbon output, and reduce waste. It also means having a diverse and inclusive workforce at the entry level all the way up to the executive level and to the board of directors. ESG may be costly and time-consuming to undertake, but can also be rewarding into the future for those that carry it through. According to an industry report, investors held $18 trillion in assets chosen according to the ESG principles in 2020, which is up from $12 trillion just 2 years earlier. ESG-specific ETFs also reached a record $400 billion in 2021, which is up 33% from the year before. And this trend is not going to stop, as it's expected to continue to grow rapidly in the coming years. Investment firms following ESG investing often set their own priorities. For example, the Boston Trillium Asset Management, with $6 billion under management as of December 2021, uses a variety of ESG factors to help identify companies positioned for strong long-term performance. As ESG investing can help portfolios avoid holding companies engaged in risky or unethical practices. To assess a company based on ESG criteria, investors look at a broad range of behaviors and policies. The business of calculating ESG scores is a complex one, with multiple third-party providers offering these services. Among the most well-known vendors of ESG scores and ratings is the Bloomberg's ESG data, Fitch Ratings, and MSCI. The specific calculation of an ESG score can vary based on the vendor doing the scoring. Many vendors will have their own criteria and use various algorithms to reach a final score, so it's not that accurate. I personally am not a fan of ESG scores at all, and believe that it is another form of restriction and control on companies. And we will get more into that later in the video. But let's take a look at the pros and cons of ESG first, before I go on a rant about how ESG scores have greatly affected Target and Bud Light. You know what I'm talking about. All right, let's start with the pros. Some analysts have argued that in addition to their social value, ESG criteria can help investors avoid the blow-ups that occur when companies operating in a risky or unethical manner are ultimately held accountable for its consequences. Examples include BP's 2010 Gulf of Mexico oil spill and Volkswagen's emissions scandal, which rocked the company's stock prices and cost them billions of dollars. The ultimate value of ESG investing will depend on whether they encourage companies to drive real change for the common good or merely check boxes and publish reports. And that is unfortunately most likely what is happening. Just checking off boxes and not actually making a difference. And that's the case, then what's the point? And now the cons. The main downside of ESG investing is that you will not be able to hold some of the highest returning companies available on the market. For example, tobacco and defense. Two industries avoided by many ESG investors and ETFs have historically produced well above average market returns. In other words, investors are sacrificing a small amount of returns in exchange for making investments that fit their values. And many ESG investors are willing to take that trade-off. Nearly half of ESG investors said they'd be willing to take a 10% loss over a 5-year period to invest in a company that aligns with their ESG standards and values. Like what average investor actually wants that? Who wants to take a 10% loss just so a few people can be appeased? Definitely not this guy. And this leads me into the controversy of Bud Light and Target that has been going on in the past few months. I am not going to go into details. However, you can easily Google it, but I will tell you that their losses were in the billions just to satisfy their ESG scores. Target started selling clothing and products to kids that are based on LGBTQ values, and Bud Light had a trans woman become the face of the brand. Even though these moves satisfied the company's ESG score, it destroyed the share price, the fan base, and they are still continuing to lose billions of dollars. This was a major hit to shareholders. It will take a very long time to generate those lost billions and even longer to gain the trust of future shareholders. And this is only the beginning. Let's see what other companies start sacrificing share prices for their ESG scores and hurting their shareholders. So Jacob Rant, are you ever going to invest in ESG focused companies, or are you all about the profits? Well, my awesome people, I am not going to say never that I won't invest in ESG focused companies. But as the trend gets more popular, I wouldn't be surprised if some of the companies I already own start shifting their focus to being ESG conscious, such as Coca-Cola and AT&T. ESG investing focuses on companies that follow positive environmental, social, and governance principles. Today, investors are increasingly eager to align their portfolios with ESG-related companies and fund providers, making it an exciting area of growth that also has positive effects on society and the environment. In other words, it could possibly be great or just a short-term trend. Personally, I am investing not to make the world a better place, but to make my life better through dividend income and profit taking. So if I know that a company is focusing on everything else except building and expanding their company, then it is a sign that they are not focused on their shareholders. So whether or not ESG investing is right for you depends on whether you want to combine your values with your profits. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please do your own due diligence because I am just a clown on YouTube. Stay ranting.